All right. Happy Tuesday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly whirlwind through all the latest news and developments with the mortgage industry. Each week, I pick one of our lender members to be my co-host. And this week, first time in the co-host seat, guy I've known a long time, fellow Ohioan, just down the road from me, the Senior Vice President and Director of Secondary Marketing for Premier Bank, Brooks McDowell. Brooks, good to see you, bud.
Good to see you too, Rich. Thanks for having me.
And if you could, for just a level set for the audience, if you could, Brooks, just tell us a little bit about Premier Bank and the mortgage banking operation within it.
Yeah, sure. So Premier is sort of a new institution. If you're not familiar, it's really the combination. The Premier was created via merger from Home Savings Bank and First Federal Bank of the Midwest, if you're familiar. So two banks merged, announced the merger in late 19, and literally we merged about 3 weeks prior to the pandemic. Sort of an interesting time to go through a bank merger and go through a pandemic all at the same time. And that wasn't by design, but anyways, here we are, sort of a thing. But we became Premier Bank after the merger. We lend in Ohio, Pennsylvania, Michigan, Indiana, sort of the surrounding states of Ohio. We're typically about a $1.5 billion origination group. We're originating sell model. We sell to Fannie and Freddie. Most of our originations are sold to Fannie and Freddie. We do put some loans in the portfolio, so we do some of that as well. But we're really sort of a growing community bank, if you will. We're retaining the servicing, but we have a fairly sophisticated mortgage banking operation. We're selling to the agencies. We're selling to the investors. We put loans in our own portfolio. So we kind of have a wide variety of product offerings and program offerings to sort of meet the customer's needs and to deliver loans in the secondary market. We're a big construction perm lender, but we do a little bit of everything as well.
Good stuff. Thanks for the overview, Brooks. And yeah, community banks positioned really well right now. You mentioned a couple things, having ability to access the portfolio, also having the secondary market outlets. So good climate right now for the community banks, even though the overall climate a little bit challenging. You mentioned some of your history of the home savings that you mentioned. A former of mine as well. Last week's co-host, last week at Mortgage Today, was both of our former boss, Stan Foraker, and I worked for Stan at Home Savings. I made a move to another bank, and they brought you on board, and we knew each other. So it was a cool cycle. So
there's two people in the industry. I always say there's the 6 degrees of Rich Swerbinsky and the 6 degrees of Stan Foraker, right? You can pretty much tie everyone back to Rich and Stan, and I'm sort of lucky enough to sort of know both of you, and sort of interesting times with the old home savings and loan, I guess at that point probably, but good to know Stan. I'm sure he had a lot of insight and a lot of home savings connections.
It's like like the Bill Parcells and the Nick Saban coaching trees of people.
Exactly.
Stan Foraker in the audience today.
Secondary market guys and football coaches. I think everyone's from Ohio.
All right, let's go ahead and get into it, Brooks. Let's go ahead and just start with this past Friday's jobs report. Very strong, much better than anticipated, and actually stocks tanked off it because they fear that good jobs will cause the Fed to act more aggressively, and the markets are living in fear of Fed hikes right now. And more broadly, though, it feels like we are in the midst of kind of a reset in our industry right now. We had just this insane first 6-7 months of the year with this big run up in rates and home values, just zero inventory. And it's been a slow bleed in terms of the improvement, in terms of rate reduction and inventory picking up. But it's been consistent, steady improvement. It feels like we're setting ourselves up with hopefully be a more healthy and normal latter part of the year here. Your thoughts?
Yeah, it's funny, when I saw the jobs report, and I do this sometimes, I thought to myself, is this good news or bad news? It's obviously good news for labor markets, but is sort of additional job growth, is wage improvement, which sounds good on the whole, and normally those are good news. I think the market's still sees that as a little bit inflationary. It still puts a little bit of pressure on rates. So it was sort of a good news for the labor in the market, bad news for, the price market sort of a thing. And we started to see that, rates kind of ticked up. We were seeing rates really decline going into the jobs, late last week, went into some of the jobs numbers, and then started to pull back a little bit when some of the jobs numbers maybe looked a little bit better than what we were expecting. Well, that's good news for, those looking for jobs and labor markets. It causes a little bit of inflation pressure. I think we're still seeing that a little bit. So it's sort of like that teetering edge between, what kind of report do we want to see? Do we want to see really good job numbers? Or do we want to see a kind of, just slow and steady sort of a thing? So it's really a conundrum right now when we see some of those economic reports, because it's like, is this inflationary or is this good for the economy?
Really bizarre.
You get your head wrap around it sometimes, but
you're a very accomplished cap markets professional. You watch the markets every day, but what you just said is so true. Like historically throughout time, like good economic news would cause stocks to rally and bonds to sell off. Being a little generalizing here. And the flip side, right? I mean, bad economic news is going to cause stocks to tank and bonds to rally. But now recently, is it recession, non-recession, inflation? There's so many moving parts that you're seeing strange market reactions off news. To your point, you don't even know, like, are bonds and or stocks going to rally off this news or sell off? It's kind of weird. They move the same as well. Typically stocks and bonds move opposite, but we've seen a lot of similar.
And I think that's, you started to see stocks sell off of that report. And it was, I think it was, this might be a little inflationary. This is good news, but it's still, there might be some price pressure in the market. And, does that continue the Fed on their rate hike schedule? Continuing to tighten by 75 basis points, per meeting. It seems like they're still on that trend. They're going to wring out inflation one way or another. And we're going to have to kind of deal with it. They haven't moved off that plan just yet. So it was one of those things. It was great news from the labor market, but still probably some price pressure. But rates have declined, obviously. I mean, from where we were, I took a look at our rate sheets and our pricing going back to June, and we touched 6% on conventional pricing. And here we are, back into the upper fours, low fives, depending on where you're pricing. Adjustables, you can still see some good deals. They might be adjustables. You might be able to get into the fours on some 30-year fix, but maybe you have to pay some points. Buy downs are cheap, which is good. You can get a little purchasing power there if you pay a little in points. In most markets, it's not really recommended that you pay a lot of points, but right now there's some deals out there where you can buy down for a point, you can buy down by a half point, 5/8 of a point, that sort of thing. So the rate environment is definitely getting better than where it was, say, 2 or 3 months ago. But there's still a challenge, and there's still, I think, some upwards pressure on rates just because of, some of that, lack of slack in the labor market.
Yeah, and on the labor market front, Brooks, got a report. I just shot you a note on just before the show because I thought it was relevant. Labor productivity in America. Report just came out from U.S. Labor Department this morning. In a nutshell, labor productivity in America is at its lowest point since 1940. Dropped at an annualized rate of 4.6% in Q2. It was after a drop of 7.7% annualized in Q1. Our industry, I've just heard it talking to our members, leaders like yourselves, and we've seen it in TMC benchmark. Mortgage industry is still largely very much work from home. So, I think broadly in America, we're seeing just worker productivity is at the lowest levels it's been at since the Indians last won a World Series, 1948.
Yeah, I mean, you're seeing slowing growth and you're seeing, increasing labor costs. So that's obviously, the lack of productivity is no surprise. And we're seeing it a lot in our industry. If you look at, the first quarter MBA performance report, I believe the fourth quarter of this year, loans closed per FTE, fulfillment FTE, we were 5.2. Look at the first quarter, we were 3.7, loans closed per FTE. So we're seeing, shrinking production. We're still seeing costs, even back office costs increase. It's not even just, loan officer costs. It's production costs, back office costs increasing. And then obviously, overall lending activity slowed down a little bit. So yeah, productivity, we're kind of getting it from both sides. Unfortunately, bad guys from both sides. We're seeing slow growth, increase increase in costs, and that's pinching.
It's crazy. If you would have, like 6, 7, 8 years ago, said, hey, 7, 8 years from now, it's still going to be take the mortgage industry 43 days to close a loan. Still not going to have e-close, and the cost to originate is not going to have been reduced at all.
Right.
When companies,
Right.
big tech companies like Ellie Mae and others in the mortgage industry
Mhm.
really started getting going 7, 8 years ago, after kind of like stem back the push button, get
Yeah.
mortgage, Rocket Mortgage Super Bowl commercial, you started to see the point of sale platform.
Right.
Here we are. I forget how many years ago that was. See it 7, 8 years later, and not a lot has changed. The average time to close a loan right now in TMC benchmark for our network, it's like 41.1 days or something, which is where it's always been historically with some.
Yeah. Yeah. And we used to, say, well, it's compliance costs. Compliance costs are driving up, the cost to do business, but it doesn't feel like, necessarily that's the case anymore. I mean, compliance costs are obviously, they're always there, and they're always, they're always a challenge, and they're always rising, but it doesn't seem like that's the culprit right now. Something we may have thought would have been a bigger issue 7 or 8 years ago. It's really just the labor cost. And you're right, even with automation, we haven't made any huge strides there. It's not adjusted for inflation, but I mentioned that MBA performance benchmark. And, if you look at quarter after quarter, those costs continue to go up. Sometimes they steady in good markets when we're doing a lot of production. But if you look at the average cost per loan, I think it went up by $1,200 just quarter over quarter this last quarter, at least according to the MBA survey. So, yeah, that cost just continues to go up, and we just haven't made, even with some great new technology in our business, just it hasn't seemed to bring down the production costs, at least yet.
Yeah, a lot of factors for that, and the pandemic is one of them, because it just got so busy. Lenders couldn't, like new tech implementation largely was paused for a year and a half or two, but it is kind of crazy. So this is the last week in Mortgage Today. I am Rich Swerbinsky with the Mortgage Collaborative. This week joined by Premier Bank Senior Vice President and Director of Secondary Markets, Brooks McDowell. Brooks, inventory, the biggest headwind to our industry. Demand strong, rates coming down, prices and values stabilizing. Still, inventory issue in our industry. Inventory is getting better, but very slowly. The oversimplified way to look at it, we're up. You look at the weekly inventory counts, up about, it's been like on average up like 1% week over week for the better part of the last couple of months. So we've seen some increase. Year over year, total listings are up 32% currently from a year ago. But they're down 11% from 2 years ago. So the inventory issue, there's no quick or easy fixes, but it feels like it's in a continually improving situation as we get deeper into 22 here.
Yeah, it's you can see it improving, but not fast enough, that's for sure. And it was just so tight, over the last 12 months that, just a small improvement is really probably not something that's really going to change the market all that much. Anecdotally, you can see some improvements. I'm sort of a Zillow geek, so I kind of daily check, what houses are available, around where I live, sort of a thing. And you can start to see more houses become available, and you can start to see that, they're on the market for a little bit longer than what they were, say, even just a few months ago when houses were literally being snapped up in 24 hours, sort of a thing. But, obviously refis are gone. Construction's a little bit of a unique market right now with just everything going on with supplies and the ability to, sort of accommodate all the customers. So, you kind of think this is a purchase market, but just the inventory challenges are really problematic. It's just, there's not enough deals out there, and everyone's fighting over the same deals. When people kind of hear, that it's a tough purchase market, they start to think, well, is it a bad housing market? It's not values. It's just the amount of, homes available. And right now, just for the purchase market with lenders, there's just, not enough deals to go around. There's just not enough houses for sale. It's going to be interesting to see, if home values start to pull back or plateau a little bit, which I think they might start to here second half of the year as we go into 23. If that changes anything, but you start to wonder from the seller side, if values aren't quite as high, maybe you've had some sellers, recent sellers, try to take advantage of the increase in home prices. But if they start to level off, or maybe a slight pullback, that sort of thing, is there going to be as many motivated sellers out there, or someone to try to take advantage of, taking advantage of the tops of the housing market? So it's going to be interesting to see how that plays out. It's improving, but not fast enough.
Very well said, Brooks. Other news this week, federal government out there has a proposal for changes to CRA Act, Community Reinvestment Act, and which decades and decades ago was created, and just the world has changed since then. And government is proposing some changes to CRA that they've opened up for public opinion, and according to a news story that came out this week, they've gotten a lot of opinion on that. Any thoughts on the CRA proposed changes, Brooks, or just as somebody that's worked for depository institutions for some time, how you manage to it and achieve your goals?
We're a big seller to Fannie and Freddie, but we also have our own CRA program, an LMI program, which had a lot of success. We've traditionally tried to, tackle the CRA challenges through our own portfolio program. Obviously, going to the agencies, they have some good programs, but there's been some scrutiny there. So we really just, we have a good solid, zero down LMI program. It fits, it works, it's fixed rate. We just kind of tackled CRA problems sort of internally, putting loans in our portfolio. The CRA, the agencies, we've had conversations with them. I know, especially Freddie, they'll definitely reach out for, new available LMI programs or CRA programs for lenders in our footprint, but sometimes, or for loans in our footprint, but sometimes, they're not really offering, where their target areas don't necessarily overlap our target areas. And it becomes a challenge. So we've traditionally stuck with portfolio programs as opposed to, finding outlets for the secondary market. If a loan is in a CRA designated area and it meets secondary market guidelines, we'll sell those loans. We participate in all the agency programs, sort of a thing. But we've kind of taken a two-pronged approach where maybe the agencies have fallen short. We have our CRA program, which we think is very strong and sort of fits our needs. So we try to take it in our own hands rather than leaving it up to the agencies to design programs for us.
It's outstanding, and smart. And one of the advantages of being a lender that does have a portfolio is you can craft programs that don't necessarily have to meet the guidelines of GSEs or any investors, that are really impactful in your specific community and meet the need of aspiring home buyers in that area. And great to see that Premier is still so active in that area.
If you can do it, you kind of know, sometimes your market better than others when you kind of go to national, or aggregators, that sort of thing. So, we've designed programs and tailored programs that sort of fit the needs, in our footprint. If it meets agency guidelines and we can sell it, great. But if not, we have a program that's a strong program that we can offer our customers.
Outstanding. Other news that came out this week, Fannie Mae does a monthly consumer home buying confidence index report that, essentially pools, a large amount of prospective home buyers or sellers to gauge, their perspective on the climate of the market. And not a rosy report for July, but my guess is, with August, we've seen, rates fall and some other positive news with inventory and other things, that we'll see this reverse. But at least for July, just 17% of those surveyed said it was classified now as a good time to buy a home. It was down from 20% in June. But then on the flip side, the percentage of people that said it was a good time to sell a home also dropped from 76 to 67%. So to your earlier point, Brooks, some of the things we talked about that are happening right now that are helping buyers get into homes. To your point, it's on the flip side, challenging the sellers.
I think, and sometimes those consumer confidence numbers, it's interesting. Sometimes there's a little bit of a month or two lag. But we were starting to see in the spring, we felt like there was just a lot of on the buying side, just a lot of fatigue out there. Buyers were getting tired of getting into, just bidding wars where, with 10 different other 10 different other buyers, trying to pay 50, 60, 70,000 over list price and just not being able to do the deal. So we started to hear a lot of, buyer fatigue. So that's not surprising. I figured on the buying side, which is values just went up so quickly and by so much that there's just going to be some buyer fatigue out there. And then rates, the rates on top of it. Not only was the house costing more, their cost of financing increased. They started working with the loan officer in January. They told them their 30-year fixed rates are in the threes, and then they called back in February and it's in the fours, and they called back in April and it's in the fives, or we can get you in the fours. You got to take an adjustable sort of thing. So I think there was just a lot of fatigue out there with buyers between just the prices of homes and then the increasing cost of rates. So that doesn't surprise me, but it was a little, it is a little interesting that we're starting to see some of this on the seller side too, that sellers are starting to say this might not be the best time to sell. I thought that raised my eyebrow a little bit because I was expecting this. I sort of heard this on the buying side, but not as much on the selling side. So that will be interesting to see. From the selling side, rates have kind of stabilized a little bit. Maybe customers, once they kind of refresh themselves, they'll start to get back out there and buy again. Maybe price levels will start to plateau a little bit. Rates have started to plateau a little bit. So we'll just be in maybe a better buying environment, house selling and buying environment in the second half of the year as opposed to the first half of the year. But it was a little interesting to see that the sellers have started to feel it already because I can see it from the buying side, but it was a little surprising to see it from the selling side as well. So let's kind of hope that price levels starting to settle changes that attitude for both sides.
Yeah, it's really interesting because historically this index, we've been keeping an eye on it, and as the percentage of people that say it's a good time to buy drops, typically the percentage of people that say it's a good time to sell increases. But this was the first deviation to that. Tired buyers, fatigued buyers, a couple of great terms you use. I think that really accurately represents just the home buyer climate earlier this year. But that could really start to change. People have short memories is the one thing I want to remind people. Right now, 30-year fixed rates, good credit. My guess were what, high fours today, like 4.9, 4.8, something like that. I mean,
we're low fives, but like I said, you pay quarter point, something like that, you can all of a sudden get down to 4.9 or 4.875 sort of a thing. So, rates are give or take 5% on fixed rates. Adjustables, you're still seeing great deals on adjustables. You're still seeing 7/1 arms in the low fours sort of a thing. Which is a popular product. We've done a lot of 7/1 arms over the last 6 months. It kind of turned into an almost, I don't want to say an arm market, but you definitely started to see more arm activity than fixed rate activity over the first half of the year. So yeah, I agree with you. Everyone has short memories. Once if people were in the market to buy homes, maybe they'll take the summer off. Maybe kids go back to school. Maybe they see that prices have started to stabilize, rates have started to stabilize, and they'll change their tune. And sellers maybe won't. Values have stayed up enough that sellers are still interested in that market as well. But we'll see. I think it actually is a lot calmer of environment to buy now as opposed to say 3 months ago. But maybe some of those customers that were in that market want to take some time off before they re-engage in the home buying process.
4.99 right now sounds low to me. It really does. If you would have told me back in the fall when rates were 2.25 that 4.99 would sound low on August 9th, I would have told you you're crazy. Or even earlier this year when rates were 3.25, 3.5, that 4.99 would have some sales appeal in August. But I think it kind of does right now. And then not that there's a ton of homes out there to buy, but it's and historically it's a very low rate. And then the refi side as well. Credit card debt is at an all-time high in America. Mm-hmm. I think the average rate I saw on that American credit card debt is like, I don't know, 16.6 or 16.8.
Yeah.
So, for the refi part of our business, that, oh, there's gonna be no refis for 2-3 years and we're gonna be 70%. Like, no, people have to refi.
Yeah. Yeah. And we're starting to see, we're seeing a lot of cash out refis just because people, maybe sort of the buyer fatigue. I think some people started to say, you know what, I can't buy a home, but I have a lot of equity in my current home. Maybe I'll pay off some, maybe I'll refi, do a cash out refi, maybe I'll pay off some debt, maybe I'll remodel, maybe I'll add on, maybe I'll do whatever I need to do. Rates are still, okay. And rates in the fours, I think you can sell rates in the fours. When they start to get up into the upper fives and, like I said, we've been touched 6% there for a short period of time. That's sort of a tough sell. I think that's when people started to really open up their eyes. But, really right before the pandemic, it's hard to kind of think what rates were at, but we were probably in the mid to upper fours. Mm-hmm. I think people can tolerate that. I think that feels reasonable. So, we're seeing some cash out refi activity, just customers taking advantage of rates not being, coming back a little bit, and then maybe doing something different with their house, maybe remodeling as opposed to buying. So that will still be there. It'd be nice to see some more of it, but it's definitely more palatable to see rates in the fours than when it was approaching 6%. That's for sure.
This is the last week in mortgage today. I am Rich Swerbinski with the Mortgage Collaborative. This week, joined by Premier Bank Senior Vice President and Director of Secondary Markets, Brooks McDowell. Just a couple minutes left, Brooks. Anything else? You've been, studying the markets your entire career. Any just broad perspective on where the markets are at right now? The interest rate climate, by far the number one feedback and question we get on all these shows is like, tell me what's going to happen with rates, or tell me something smart about the rate climate that I can share with my pre-approved borrowers or referral partners. So any words of wisdom to...
it's a difficult market. Sometimes when we're in these difficult markets, for mortgage, I don't want to say it's easy. It's never easy. But, we have something where the Fed's pumping money into the system. Now we're sort of in this environment, and we haven't really seen this in probably several decades, where the Fed is actually pulling money from the environment, which has made, especially the secondary market, very challenging. So we're struggling with that, and everyone is. We're starting to see a lot of unique things with pricing. Starting to see premium pricing sort of go away. We started to see, certain products you just can't get a par rate. You have to pay 2 or 3 points to get, to obtain some sort of rate. It's just been a really unique market. So, we're working our way through. I think markets are starting to settle a little bit, and we're starting to see more normalized pricing. But pricing started to get a little crazy there, back in the spring. So it's just a unique market when everyone kind of thinks, oh, things are bad. When we were in the recession of 2009, or when we were in, maybe 2003, or we've been in some difficult time periods, financial, economic type environments. There's been money being pumped into the system. So it's been, the mortgage market has acted fairly normal, where this has been a sort of an interruption to the pricing market and something we haven't really seen. So obviously navigating it the best we can, but it started to impact different products and different programs. And I think it shrunk the market a little bit. So it'll be interesting to see the second half of the year how lenders react. I think things are starting to settle down a little bit. But we're also starting to see, applications slow down a little bit. Applications were better in the spring. We're starting to see a little bit of a slowdown, and I think the industry is too. So it's going to be an interesting second half of the year. I don't know if there's anything, any great advice out there, for lenders. Just, try to attack every deal you can. Buy downs are cheap. I said that. Buy downs are cheap. So look, in certain markets, we're not offering rates with points, but in some areas, we have to do it, and it's actually a fairly attractive deal. So we're just really trying to attack every deal we can and win every deal we can, and navigate the market that we're in right now, because it's something we haven't really seen in the last 20 or 30 years.
Well said and good stuff, Brooks. Always enjoy catching up with you, talking about the business. Thank you so much for joining me this week and spewing some knowledge at our members. And just really appreciate your time this afternoon.
Great. Thanks, Rich. It was fun. Thanks for having me.
And to our attendees, thank you for spending 30 minutes of your week with us. We're here every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. You find us on YouTube after live video, our live feed, obviously Tuesdays at 2, and then on podcast where the majority of you listen. Search TMC Connect wherever you get your podcasts to listen to the show that way. So, Brooks, thanks again. Have a great rest of the week. And until next Tuesday, have a great week, everyone. Take care.
Thank you.
Bye, Brooks.